Good morning, everyone, and welcome to your next panel. Does liquidity matter and come with a price after all? My name is Madeline Farman. I'm a senior reporter with PEI's publication Private Equity International and Secondaries Investor. And I'm joined by three experts who will be addressing this question and quite a bit more if we have time. This is a topic that we could probably speak to for about 2 hours, but we've got half an hour. So I think we'll just jump straight into things. So maybe if we start off, can I ask you all to introduce yourselves and maybe talk to the point of either how you offer liquidity or access liquidity? And maybe Francois, seeing as you're sitting next to me, we'll start with you.
Happy to start. Good morning, everyone. So Francois Aguerre, I'm the co-head of investment at Color Capital. We are a global secondary specialist. We provide all type of liquidity solution you could imagine in private markets, effectively. So we are on the providing side of it, and we operate globally.
And Alex.
Hi, Alex Shivananda. I'm a managing director, partner, and head of secondaries at Cambridge Associates. So many people know Cambridge Associates as the provider of benchmarks for private equity funds. What people may not know is that we actually have over $500 billion of assets under advisory. And so we basically track 24,000 funds. We go to 2,000 meetings with managers each year. And we do 200 due diligences on funds every year. And so we have quite a broad and detailed view of the liquidity in the markets on a real-time basis. And we provide liquidity in three ways. One is we manage client portfolios, build, manage, and including liquidity planning. And that means also selling into the secondary markets. The second is that we provide funds and allocate to primary and secondary funds. And the third is we actually participate in secondary transactions ourselves. So we're kind of a little bit of a spider in the web in the secondary market, as it were.
And last but very much not least, Eric.
Hi, I'm Eric Durham, managing partner of Flexstone Partners. So we're 10 billion assets under management, private equity firm. What we do is we build and manage portfolio for our clients as well. We do SMAs, secondaries, and co-investments. So in terms of liquidity, similar to what you just said, Alex, we have secondary funds. We manage the portfolio of our clients, and we sell, whenever we think it makes sense, or our clients ask us to sell the portfolio, or we obviously buy through our secondary funds. And we have a global presence with offices in the US, Europe, and Asia.
So maybe to dive into pretty much the key question that this panel is asking us. For an illiquid asset class, does liquidity matter after all, particularly if we consider the current backdrop that we're seeing at the moment for private equity and private capital more broadly? So Francois, I'm going to start with you on this one.
No, happy to start, of course. I mean, the one way to think about it on a high level is companies go bankrupt because of lack of liquidity. So by definition, liquidity matters, and it matters for everyone. In the private market space, if you think about it, the fact that people are willing to sell to us on average at a discount, to use the D word, and also the fact that we deliver strong returns to many investors around the world on a consistent basis is just telling about the fact that this liquidity is valuable for the market. And so the last concept I would leave at this stage, really still high level, is there is a slight mismatch of duration typically between the LP community and the GP community. So the fact that we are in between, again, really high level, is really trying to bridge that mismatch between the two. That's the best way, I think, to conceptualize liquidity in private markets.
And Alex and Eric, I don't know if there's anything that you would add to that particular point as well.
Yeah, I mean, it's interesting, right? When investors invest in an illiquid asset class, by definition, they should model that illiquidity. And therefore, in a funny sort of way, liquidity should not matter because it should be embedded in the investment assumptions, right? The reality is that the secondary market in private equity has increased from 2 billion, I was checking the numbers yesterday, 2 billion in 2001, to how much was it this year? 100 and something
yeah,
billion?
105.
So 50 times bigger, right? So the reality is that there's a need for this, and as you said, the reasons are circumstances change, market change, and people need liquidity at some point in the duration of the investments.
I mean, I guess the only thing I would add is that it's really client-specific as well. So we represent various endowments and foundations or hospital systems, let's say, that also really need liquidity for their operational budgets, right? And so it really matters to them in terms of whether or not they're getting liquidity they expected.
So we're starting off from the premise that liquidity matters. So maybe to dig down on how realistic sort of expectations are with, where LPs can get liquidity. So can the LPs at the moment reach their full expectations, for liquidity on the secondaries market as it's funded currently? I'll leave that open to all of you. And do they have to modify maybe their expectations on what they can achieve if they go out to the secondaries market and say, I want to sell this portfolio, please, secondaries buyer, pick it up for me?
I'm happy to start, but I think it's very important to understand that there is no way the market can cope with the potential supply. So I've been 16 years in this industry. There's always been an imbalance between supply and demand. Just right now, there is no way, because, of course, for us, like everybody else, it takes time to fundraise. We are raising very large funds. Not we call it the industry. Can't talk about fundraising. The industry is raising very large funds, but it's just a headline number. All of those funds put together in the context of private markets, it's still a drop. If we continue with only 1 or 2% of LPs willing to get some liquidity in their portfolios, then maybe you can match the two. As soon as you go to 2 to 3% or 3 to 4%, that's it. The system is saturated. So there is definitely not enough buyer's capital to satisfy that liquidity. But that liquidity right now is very critical. It's very critical for operations, as Alex said, but it's also very critical because even more than the pure performance of their programs, the LPs are always very focused on the balance between their own cash flows, calls distributions, or you name it the way you want. This balance is not in equilibrium right now, and so they are struggling with how to figure out liquidity in there. You could get a little bit of financing. You could get, of course, the secondaries market, but we're short of capital as an industry.
Can I just add? I mean, if you look at the numbers, market participants expect the secondary market to be worth about $130 billion of transaction in 2023. So back to where we were in 2021. You have about 120 billion of dry powder right now, waiting to be invested, and there's about 70 to 90 billion of fundraising going on for secondary funds. So it represents roughly 2 years worth of investment, and it takes time to invest. Right? So there's definitely a funding gap between the secondary capital available and the expectation for people who are going to sell some of the portfolios. And it's particularly acute, I would say, in the smaller end of the market, because if you look, it's a highly concentrated market. I didn't realize this, but the 4 biggest secondary buyers represent more than 50% of the market, actually 51% of the market. And if you take the top 12, it's 75% of the market. So these are big funds doing big transactions. So if you have a small portfolio to sell, you may have to settle for a lot bigger discount if you want to transact, because there's so much less capital available for this.
No. So the other thing, Madeleine, is to your question, is the sellers also need to realize that it actually takes a little bit of time and a little bit of effort to go through a secondary transaction, right? It takes maybe 6 months. You're going to be paying fees to an advisor, and you're going to be taking a discount. So, from the seller's side, it's not just a very, let's say, quick decision, and there's uncertainty, ultimately, if you're going to get the price that you want.
And I want to bring in, obviously, it's not just LP stakes in the secondaries market. We've seen the rise of GP-leds over the last couple of years as well. And, from my perspective, I'm hearing more and more about tender offers, stapled tender offers as a way to generate liquidity for your LPs and hopefully get some primary capital, as well as those investors giving money back into your latest fund. So with all of that being said, how realistic is it that, maybe just to sort of clarify it as what the split will look like into this year between the GP-led opportunities as well as the LP-led opportunities, and how many transactions realistically will we see get done? How much liquidity will be serviced this year?
I think it's very important to bear in mind that all of us, we create labels. So GP-led transaction, the concept did not exist. So the concept itself, transactions have taken place for over 20 years, but didn't exist maybe 3-4 years ago. So we like labels because it helps us understand a little bit better what's going on. The reality is that all of this is just one continuum. It's one continuum which is capital flowing from the LP to the GP through the secondaries market or through other intermediaries. And then the question when you are on our side is, where is it that I get the best risk return? There is concentration, there is diversification, there is quality, therefore a different risk profile, irrespective of the concentration because of the assets and the GPs. So you take all of this into account. And so right now, for instance, what the market has done to some extent in 22 is to say, it finished investing in a number of GP-leds in Q1 22, and then market said, okay, so you can get good quality at 15-20% discounts, diversified through LP-led. You can go to the best assets with the best GPs at par, plus minus, with economics on top. You've got 20% differential in pricing. Doesn't make any sense to go higher risk versus. And so you ended up with the LP market, taking over, which is likely to continue, I suspect, in 23 to a large extent. So you have that rationale and that assessment going on. I think what's important is not to see LP versus GP as two competing markets. Again, it's whole one market. Like on the direct side, you would go sometimes for specific sectors, and there are other moments when you will go with other sectors. There are good moments to push on one and good moments to push on the other one.
I totally agree with that. Just to add briefly, the secondary market in 2023 is, has a lot of tailwind. For LP stakes, it's the denominator effect. We talked about it, I'm sure, in other panels. For the GP-led, if you look at the number of exits in 2022, it was down 60% from 21. Obviously, 21 was an exceptional year, but still, you have a lot less exits happening right now. I don't have a crystal ball to say what's going to happen in 2023, but for sure, there are a lot less exits. And the GP-led opportunity is a way for GPs to offer liquidity when there's not much going on, not much liquidity going on in the market, through the natural exit process. And remember, last year, for the first time in, I think, more than 10 years, there was a huge cash flow gap between distribution and capital calls. For the last 10 years or so, capital calls were big enough distribution were large enough to be able to fund capital calls. But last year, according to Prequin, I think, there was a $500 billion funding gap, and that is not sustainable for LPs, right? So either they will have to stop the new allocation, or they will, the GP will find some exit through GP-leds for them.
And I did want to ask, this is a very different market to what we might have seen in previous crises as well. So how are new solutions or the normalization of particular solutions alleviating points that have posed issues in previous volatile times or crises? It doesn't have to be secondaries. It can be more broadly as well.
Right. Just on the secondary side, even though, the names have changed, et cetera, I think, the interesting thing is for GPs, it is a third option. Right, you can IPO your business, sell an M&A transaction, right? And this suddenly has become a viable third option to put your star performers into a continuation vehicle and put that into a GP-led opportunity. So, I mean, that is new technology, as it were, that is making a difference. One thing to add is, there was a need for liquidity both on the LP side as well as on the GP side for showing exits and fundraising. Because the LPs aren't getting their liquidity, what we are seeing is that 80% of the time, in terms of offered a liquidity option in a continuation vehicle, they are taking that liquidity because they're not getting it elsewhere. So in any case, that just says something about what you can do differently now than what's been happening before.
There's a few other big trends happening, I think, and one of the main ones I can see, and it's tied to the fact that the retail is more and more interested in the asset class, is those semi-liquid evergreen funds, and regulation and the regulator in general has been very, I guess, enthusiastic about allowing this to happen, whereas historically that was not the case at all, right? So whether you look at the US or Europe with the LTIF 2.0, for instance, that is going to come on, available this year, you will. My view, our view at Flexstone Partners is that you'll see a lot more of those funds, which are, I guess, copied from the hedge fund world, where you have liquidity gates on a quarterly basis, and you in fact can invest in a panel or a broadly diversified portfolio of private equity assets in a fund where you have some sort of liquidity. I think that is still relatively confidential in terms of size, but I think that will increase very substantially over the next few years. And the main reason being the regulator allows it now.
Yeah, maybe one comment I would make to add is a bit of an evolution of the industry. And what I mean by evolution is, if you think about it, a lot of the focus of on the GP-led side has been on single assets, which represent a large part of the GP-led market, but only part of it. The reason I assume the focus is because, again, it's great companies and people like to think about companies. But what's happening is that, back to my analogy from the start, at the LP level, what is critical is cash flow management. Do I have a program which works well from a cash flow perspective? It's more important compared to I'm going to go with GP1 because GP1 provides me 2.2 net versus 2.5 net. Because you need to get that equation right. And so at the GP level, what's going on as well is that beyond, I love this company, I want to keep it another 5 years, make more carry and so on, which is great, understandable. There is a portfolio management concept which has now entered the GP mindset. So there are many transactions as well where the GP would look at 1, 2, 3, 4, 5 different vehicles, 3 or 30 companies from those vehicles, and so they start managing more actively as well their portfolios to serve DPI, to serve their own organization, and so that element is really a step further beyond, as Alex was saying, beyond the third option to exit the company, which is just the usual, almost business as usual. And so that element, I think, is very important because it brings structurally more liquidity into this less liquid asset class.
And maybe to pick up on one point, particularly on the topic of semi-liquid funds, Eric, a key theme that we've been covering at PEI has been the democratization of private equity. You're seeing a range of new investors into the asset class. So now it's servicing from retail right up to institutional investors. So is liquidity more important as the asset class opens up to more investors, do you think? And maybe to start with you, Eric.
I think retail investors, as they invest a lot more in the asset class, so they should invest a lot more in the asset class, are a lot more sensitive to the option of liquidity. It doesn't mean that they will actually take the option. If you look at private wealth, they actually don't circulate the portfolio that often. But regardless of the asset class, in fact, even liquid assets, right? But if you look at the behavior at the time of investment, I think it is very important to offer those type of liquidity windows, even if it's limited and even if it can be blocked in a crisis situation. So I do think that is one of the reasons those semi-liquid product will grow very substantially over the next little while. Yeah, I don't know.
Yeah, and on this one, just for the anecdotes and on a no-name basis, obviously, but people would have seen before Christmas, sometime before Christmas, a lot of press around very large alternative asset manager in the US, their main vehicle, which was semi-liquid, tens and tens of billions, and all of a sudden having to block everything because they could not effectively deliver on all of the redemptions. So no question for those vehicles. Even more, liquidity is critical because it's supposed to be delivered. And as we know, everything goes well for everyone at the same time, and everything goes bad for everyone at the same time, right? There is a lot of correlation between all players in the market, and so everyone is looking for liquidity typically at the same time.
And before I could ask 1,000,001 questions after this one, but just very quickly, are there any questions from the audience that anyone would like to ask? We have one question over there. I think a mic's coming to you.
Hi. Do you think that CFOs are also another path towards more liquidity? And traditionally, they've been structured more to help GPs. Could they be structured more to help LPs?
Yeah, I was about to say we didn't cover that. This is also a very big and fairly new trend. Absolutely, NAV-based loans on portfolios. Yes, we see quite a lot of those going on. And there are a few specialist GPs who have raised billion-dollar plus funds just to do that. It's much appreciated. Personally, we don't like them too much for a lot of various reasons, but which I can talk for a long time about. But yes, it is a very big trend.
And there are many profiles of it. So just to put it in context, I think we did the first one, a caller, in 2005 in Southeast Asia. Again, no-name basis, but one of the players who's been doing a number of those over the years. They used to be called securitizations, GFC came, then it was called CFO, and then sometimes it's NAV lending, and sometimes, so there's a lot of different names, private backed notes, PBN. So it's, again, back to the continuum. I think it's very important to understand that all of this is all of the same, but it's different sources of capital and therefore different risk, different pricing. But it's all part of how do you inject some form of liquidity in the system.
I mean, I think one thing that's important to note is that this is kind of an anomaly in time, and it's a cycle, right? And so if you look at the ratio of distributions to contributions in private equity, the last 10 years, there's never been a bull run as long as the last 10 years, with that ratio being kind of between 1.5 to 2 times. So you're getting more money out than you are in aggregate putting in. But subsequent to the global financial crisis, subsequent to the internet bubble, this went down. So since 1991, there's never been a bull run of 10 years of there being a ratio above 1.5. So I think there's going to be a mean reversion, and some of these things are kind of solutions for now. But I think one of the things to recognize is it hasn't been a normal quote-unquote market. This is as good as it gets over the past 5, 7, 10 years.
I will take that as no other questions, but feel free to put your hand up and I'll keep an eye out. I will ask 2 more quick questions, but the first one being, it is in the name of this panel. Does liquidity come with a price?
It's a very good price right now, so please, contact me at the end of the panel. I've got plenty of business cards. I mean, so of course, liquidity comes with a price, and it's really just the basic law of the market. Supply, demand. You need to find the equilibrium. Right now, the equilibrium is more aggressive than it was a year and a half ago. Is it necessarily a problem in terms of people taking that liquidity? It's sort of a yes or no, because of course you sell at a low, but you're going to reinvest that capital also at a good entry price, most likely, whichever strategy you decide to go in for. So it's really just more of an arbitrage and trying to resolve your liquidity issue at the moment in time. You will also make us happy, and that's important because we are a good bunch of secondary buyers out there. So it's your good action for the start of 23.
I think what we're saying right in this panel is, and data, is evidence of that. Is there's a clear need for secondary funds or liquidity in an illiquid asset class, right? And as long as you have a good service, there should be a price for it, right? And as we were discussing just before, there's actually quite a lot of research done by academic on the subject. And to cut a long story short, the gist of it is that when you have an illiquid asset and you're trying to get a premium for that illiquidity, and that is roughly 5% per year, right? And when you, this academic, they did these studies and they looked at what was the performance of a seller and a buyer in a secondary transaction using public market equivalent analysis over many, many years. And it turns out that when you sell, it turns out that the buyer always has a better performance than the seller. So in theory, it should suggest that the seller should never sell because, and the number is 5% as well. So when you're selling in the secondary market, you're basically giving up 5% per annum of performance, of lost performance, right? And if you remember what I said just before, which is the premium you're trying to get in investing in illiquidity, which was also 5%, well, you're basically giving up what you're trying to get with your illiquid allocation, and it sort of makes sense, right? You're investing in an asset class which is illiquid, you want an illiquidity premium, but if you're giving that up, whatever the reasons, and there are plenty of good reasons as we discussed, well, you give that premium up. It just, it's full circle in a way, and it makes sense, I guess.
Anything to add, Alex?
No, I mean, it's inherently an illiquid asset class, right? And people have been conditioned over the last 10 years for more liquidity than maybe might be a kind of a mean reversion towards. And so obviously, if you want to get out of an illiquid asset class, it's going to cost you in one way or another.
And maybe to leave our audience with some sort of tangible information, is there any sort of advice that you would give in your sort of privileged position of having LPs, GPs come to you for liquidity? Any advice that you would give in the current environment for LPs and GPs when they approach a secondaries investor with a transaction? Anything that they should have in mind that we haven't discussed? Any interesting ways that they should present themselves? I know on the GP-led side of things, we've had some really fascinating transactions that have sprung up that we've heard about. So any advice that you would give there?
So I'm going to finish on a note which is a little bit controversial, apology for potential intermediaries in the audience. So one thing to bear in mind is that we operate, all of us, still in a very private market, right? So illiquidity aside, it's a private market. And what's important to have in mind is that if you have some specific needs on liquidity, everything is actually probably achievable in the market. It takes time, as Alex said, transaction takes time. But then what is not necessarily obvious to everyone is that if you go through the route of going and hiring an intermediary, what's going to happen is that you will get a good price for reasonably mainstream solutions because the intermediary is set up to make sure a transaction closes quickly enough because they need to move on to other transactions. So it's a fairly, totally fair business model. If you look for something which is a bit more bespoke, you are definitely still today better off engaging directly with some of us because only in those circumstances will you have the buyers willing to do the work and to provide the proper bespoke solution, which is time consuming. So I think it's important for people to have in mind it's two different routes for two different outcomes.
I'll direct my recommendation then to a different group, to the GPs, thinking about GP-led continuation vehicles. And I think there is, to get those done, they really need to show commitment. So roll all your carry, a big GP commitment. And, it's an asset, a star asset, that you think has more legs to run with. And so I think that's, that's a key part of the equation. The other two options, M&A or IPO, there's someone on the other side of that that is showing a lot of commitment to buying into that company or buying the company outright. So, somebody needs to show commitment, and I think, that's the key to success in that side of the equation.
And very quickly, just to go back to what I was saying on the lower end of the market, I think sellers will have a tough time, and they should first set their expectation right. And if they really want to achieve success and actually transact, I think they should select 1 or 2 or 3 parties working with a GP, but really commit to those type of interaction, one-to-one interaction to get this done. Otherwise, it's not going to get done.
Wonderful. Well, thank you to our panelists for sharing their insights today so candidly, and thank you to all of you for listening to us today. And hopefully that was insightful, and enjoy the rest of the conference. Thank you.